Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams, and today we are discussing, is the Williams real estate strategy for you? It's obviously not for everyone. Not everyone's cut out to build a 10 plus property portfolio. So I'll break it down today. We'll really hone in firstly on the summary of the strategy, what it actually is, and then we'll go through the types of people and personalities I think it would resonate with and will really do well with this investment strategy. So to start it off, we specialize in building solid residential foundation portfolios, 10 properties within a 10-year window, and you don't need big bucks to start. 50 grand cash, 200,000 borrowing capacity, and that's all you need, and away you go. And I can use that to keep leveraging one deal to the next in the right markets, buying the right product at the right time in the right market to keep building and scaling your portfolio. So we advocate all types of property. So if it's a unit, a villa, a townhouse, a house, a duplex, so 2 units on one site, a block of units, we stick to residential, building that solid residential foundation base in all types of residential, as we don't just push one type of product like just a house or what have you. It's every types of property at some stage has its time in the sun. So I'm not an advocate of just focusing on houses and or this certain region. We are across the whole of Australia, so every market, every type of property, all has its time in the sun. It's just whether or not you're buying that property, doesn't matter what it is, it's all about the price you pay relative to the intrinsic value. We're value investors. We like to buy property for at least half the intrinsic value. So all types of residential property works. Obviously, we steer away from new and off the plan and all the shiny stuff. It's established residential foundation, solid established property, nothing sexy, nothing flash, just fundamental affordable housing that everybody needs, especially in a market that we are in today, where you got the federal government driving record net migration, and we've always got a construction and property industry that's in behind, lagging and not keeping up with the demand. So that's where we stick to, solid residential foundation portfolios. I'll get you to 10 properties within that 10-year window, and you don't need to be on big bucks. I mean, I started on a 50, 60 grand income. By the end of it, I was on 170, 180 grand. And I built 17 rental properties across 3 states, New South Wales, Queensland, Victoria, in a 6 to 7 year window. Yes, I was going hard, but I maxed out the borrowing capacity of the big 4 banks. I then used all my borrowing capacity in the second and third tier lenders. I then opened up a trust. Depending how hard you want to go, you'll definitely be able to get there, and you don't need to be on a big income. So to break down the strategy a little bit further, our key fundamentals when buying property is to firstly buy the property for under intrinsic value and under the bank value. So under the intrinsic value is half. We like to buy property for half the cost to replace it. So these days it costs anywhere between 550, 600 grand to build a unit, and 700-800 million bucks minimum to build a house. So we like to buy units for sub 350 grand, and we can pick them up as low as 250 grand in the metros. And we like to buy houses for around like 350, 400 grand. Once they're hitting around 500,000, that's when it makes sense to start buying duplexes, so 2 units on one site. And then once we're hitting sort of 600, 700 grand mark, that's when we like to look at blocks of units. So blocks of 3s, blocks of 4s, and the sky's the limits with blocks of units. I mean, you can spend 1 or 2 million bucks and get a nice block of 8 or block of 10. Is the type of price range we like to play in. Strong yield, so minimum 5% yield, but everything we pick up is usually between the 6 to 7s and even 8% yields if you're going for the dual income properties. but typically units and houses we pick up with a 6 to 7% rental yield on day one. Growing population has to be growing. This is a big one, especially for the regions. Gentrifying suburbs, so finding those suburbs that are the up and coming suburbs that people may think, it's a bad reputation, bad stigma, but due to their location, cracking locations, blue collar working class suburbs in great locations, over time public investments invested into the area, such as building roads, trains, rail upgrades, light rails. The government sells off housing or public housing, privatises the area, that then spurs on private investment to come in, knock down old houses, build new developments, and all the bougie bars, restaurants start popping up. That's gentrification, a conversion from an area, from a lower socioeconomic area into an upper class or middle upper class area, which is driven by initially public investment from the government, investing into an area, plus selling off old housing estates as they build more estates, like selling off the Housing Commission to redeploy people into other areas as they build new urban sprawl. That then re-gentrifies and draws private capital into the markets that set them off. So classic examples in Sydney would be the likes of Redfern, Surrey Hills. Back in the day, you could have bought houses for 150 grand, 200 grand, terrace, beautiful Victorian terrace home. These days they're going for $3 to $5 million. And the reason for that is back in the late 80s, early 90s, it was a rough area, including the likes of Balmain, Rozelle, even Drummoyne, where we are today. These areas historically used to be rough around the edges, but as they gentrify, they convert to a whole new economy, a whole new area, and that's where you see the significant growth within that 20-30 year window. And our market timing is based on the 18-year land cycle. That is key. I don't see anyone else really in the buyer's agent industry and talking about the 18-year land cycle around the work that Phil J. Anderson, Fred Harrison, Akhil Patel, these guys, if you haven't heard of them, look them up, get their books, read their books. It'll save you millions of dollars and it'll make you millions of dollars. You need to get the understanding of the 18-year land cycle. I use it as a framework to work out where the best markets are performing today, because everyone has the data, but it's all about understanding what the data says and what we're coming into. So most people are rushing into the likes of Brisbane, Perth, Adelaide, Townsville, regional Queensland, regional New South Wales, like Newcastle. But the reality is those markets are not going to be performing in the next 10, 15 years, because yes, they may have another 2 or 3 years worth of froth or sugar hit as we enter the last couple of years prior to the market topping out in 26, 27. Once we hit the next GFC, which is due come 2027, the market will reset and go again, and markets that are not performing now will be the performing markets in the year ahead. This is the 18-year land cycle. It is the framework you can use for investing across all asset classes. It'll give you clarity of what the hell's going on, because the media, the government, they don't know what's going on. They're flying by the seat of their pants. So 18-year land cycle is a framework. We are, and me personally, at a core, I'm an investor. That's my number one priority, is investing around the 18-year land cycle framework. And second to that is building my business and helping other people build the same portfolio that I've done, all around the 18-year land cycle. I cannot harp on about it more and explain more around how powerful it is to protect your downside, but then also be prepared and take advantage of the years ahead. So that's the strategy in a nutshell. Obviously it's taken me 10, 15 years to develop this strategy based off my own personal experience in construction and property development when I was in the corporate game, and then now in investing over the last 7, 8, 9 years. I've now honed in on this is what our strategy is. 10 properties within that 10-year window for people starting from scratch, or if you've already got a couple of properties, I can run reports and I can show you where they sit in the market. Because right now we're in a similar point of the cycle of June 2005. 1.5 to 2 years prior to the market topping out in 2007, we went to the GFC. So that's where we sit now, equivalent point of the cycle. In the next coming years, we'll see good growth from Brisbane, Perth, Adelaide, their respective regions, but we're due for the next global financial crisis come 27. So knowing that information, you can overlay that in different markets, different asset classes, see how they perform historically, and this is what I do every day of the week to work out how to best play your investments moving forward. So who's the strategy for? It doesn't matter if you're a big shot or you're a first time investor, first home buyer. It's for everyone. But I understand building a solid residential foundation portfolio and owning property and is not for everyone. You know, I mean, even people in my family left social views and values, and they believe, you know, everyone should just have one house. So if that is your mindset, this strategy is definitely not for you. Look, you have to be a type of personality that you're looking to build your wealth for yourself and your family, set up yourself and your family, your future forever. Because a job can get you, you know, from the age of 20 to 60, 40 years. A career lasts. Wealth, intergenerational wealth through property lasts a lifetime and is intergenerational. So that's why I focus big on building your wealth through property rather than focusing on building your career, because your career will only last till you're 60, and that's if you're good. So you might as well now, while you've got the good income, build the wealth. But I understand it's not for everyone. Not, you know, if you think that it's bad to have multiple properties, then if that's your view, that's your case, then that's it. You won't ever resonate with this strategy. So that's a bit on that. I mean, you don't need big bucks to start. 50 grand cash in the bank and 200,000 borrowing capacity, I can get you going, and you only need to buy the first one. Obviously, if you're on big bucks, it'll help and you smash it out of the park as I've developed this blueprint, but you don't need big bucks to start. Everyone should aspire to have that solid residential foundation portfolio as security. It can allow you to take a couple of years off, go on a holiday, not be tied to a job or one location, working your ring out for the rest of your life. If you've got that solid residential foundation, it'll back you the whole way through the ups and downs. So if the bank, second types of people that this strategy would really work with, if people come to me, and this is a common one, the bank will lend them 500 grand or $1 million, but they want to live in a house or a townhouse or an area that the property's worth $2 or $3 million. So they basically priced out the area they grew up in or they want to live in. They want to live in the more desirable area, close to the school catchments, but they just can't afford it. This happened to me. I mean, I grew up in Drummoyne, Sydney. Houses in Drummoyne, Sydney go for, I mean, you can buy shit boxes for $2 million. I mean, $3 to $4, $5 million sort of entry. They go up as high as, you know, the waterfronts here go for, I mean, they're buying them for 12 million, knocking them down and building even bigger mansions on top. So I mean, you need a solid $5 to $10 million to buy anything half decent in Drummoyne. Obviously, when I first started, the bank would only lend me 400 grand. So we live down the road in Rod Point. I've got the boat in the bay. The house we rent's worth probably 3.5 million. We rent the family home, and I've invested my capital across multiple markets to these days carrying over 3.5 million in debt. Portfolio's worth 7.5 odd million, and I started on, you know, less than 50 grand savings and a borrowing capacity of 400,000. So the strategy works if you don't have the capital up front and you're looking to just get into the market, start building your wealth, and then start compounding your wealth. Build the portfolio first, then delay buying the family home, because then eventually you'll be able to buy a family home you would even never imagine thought being possible. So if you want to live in the desirable areas, If you want to live with the best amenities, along the riverways, with the bay runs, in the nice school catchments, so you got the great schools for your kids to go to, rent there and invest in other markets that are primed for growth with strong yields that will allow the bank to keep lending you more money so you can keep growing your wealth and expanding and growing and moving forward. And run your numbers before you get caught up in the old-fashioned baby boomers strategy of, you have to work your ass out, you save every dollar and you buy the family home, you max yourself out and you spend the rest of your life, 30 plus years tied to it in mortgage prison, paying it off for the rest of your life. Hopefully you can hang on to it through the downturns that are inevitable every 7 to 8 years. We have a big downturn. If you lose your job, then get a big fat mortgage. That strategy is well and truly outdated, especially in the cities such as Sydney, Melbourne and Brisbane, especially Sydney. Sydney is a global city. If you want to live in Sydney, rent vesting is the way to go. Run your numbers, work out how much it would actually cost to own the property. If you add up the interest costs at 6.5%, 7%, the rates, upkeep costs, insurance, maintenance, all the bullshit, add it all up, work out, break it down to the week. How much does it cost to the week it'll cost to own the property, if you can hypothetically even get the loan, but how much would it cost versus how much would it cost to rent the same place? And I can guarantee you 9 times out of 10, especially in the very desirable areas in Sydney, in the blue chip areas, eastern suburbs, inner west, north shore, of all the metro markets around Australia, it'll cost a third, or if not a quarter, or even a fifth of the cost to rent the equivalent property versus owning it. So why not you just rent it, especially when you've got a growing family, when you might not want to live in a unit or a townhouse the rest of your life. It might not be the forever home. And when you're growing family, it's easy just to call the removalists. Next day we're in a new place. That's it. Here we are. Off we go. Rather than tying yourself to one location, one asset, pumping all your capital into one location, that is more risky than spreading and diversifying your capital across multiple markets, multiple assets with that generator cash flow. And once you change your mindset and go down the investment route, the banks will lend you typically 50 to 60% more if you rent it out, if it's investment debt, versus if it's an owner occupied place of residence. So if the bank is saying, okay, we'll lend you $1 million to go and buy your first house to live in, they would lend you probably 1.5, 1.6, and if you open up a trust, even more if it's investment debt. So you'll always be able to grow your wealth further, buy more property, get further ahead if you look at rent vesting and having all your debt productive. So that's a bit on rent vesting. Run your numbers. Run your numbers, run your numbers. It just makes sense. Obviously, it's a bit of a mindset change, and it's not what your parents probably did. They probably slugged it out their whole life to hold on to their family home. But even for downsizers, if you're sitting on a $5, $6, $10 million house, the kids have walked out, they're now left, you want to maintain a big monstrosity and you're not necessarily working like you were in the heyday, run your numbers. It may be worthwhile selling down an asset to then rolling it into blocks of units, that cash flow. You can buy blocks of units for, I bought a block of units for 665 grand recently that rents out for 70,000 a year. So you buy a couple of them, you could generate a couple of $100 grand in passive income just through the rent if you're buying it with cash. So if you can sell a family home and downsize, buy something smaller and then have spare cash, you can then buy multiple rental properties in blocks of units that will cash flow, that will set you up, that is sustainable. Rather than, I guess, yeah, sure, you can go commercial, but yes, you'll get a higher yield in commercial, but when the market turns, in the mid-cycle slowdown, which was COVID or the dot-com bust, or in the land-driven downturns, which was the GFC, the 91 recession we had to have. The next one's due in 2027. Commercial property can go vacant for up to 3 to 4 years. This is what happened in history, so there's a higher probability you might lose your tenant. So you might be getting a good yield now, but you'll be getting a 0% yield when you lose your tenant, and then your property goes to land value. So blocks of units, rock solid, stable investments for the long term. You could always rent out resi within 1 to 2 weeks. If it's sitting around for 3 or 4 weeks, the rent's too high, you need to adjust it to reach the market, but you'll always find a tenant in residential, provided you meet the market. Expats. So if you're, I've been helping a couple of expats recently in the UK. Aussies going over there working, or a lot of construction property people are heading over to Saudi these days, getting big bucks with no tax. And if you're living over there, you're just renting while you're over there, or you might have a setup with the company or organisation you're dealing with, but you still want to invest back home in Australia and build the portfolio, why not? Earn the big bucks and deploy the capital into building a solid residential foundation. So I've helped multiple people overseas buy property. I can do it all online across Zoom videos. Happy to get up at 8, 9, 10 o'clock at night when it's the daytime for suitable overseas. Happy to work whenever it suits. I am very flexible and have helped expats before, and it allows you to build that residential foundation portfolio that will tick away in the background. You'll continue to build your wealth. You'll continue to put your capital and your borrowing power to work. If you keeping your capacity to work always makes sense while you're working away, or even if you're interstate worker, if you're a fly in, fly out, if you fly into the mines, or if you're an engineer chasing the work around the countryside, building roads, tunnels, for the likes of John Holland's CPB, or going out to the country and doing surveying, or doing wind farms. There's lots of wind farms these days. So if you're getting sent out to here, there and everywhere around the countryside, it doesn't really make sense to, buy a property back home where you're not going to be there. You might as well just rent it or follow the work and build a solid residential foundation, because it provides you that flexibility. You're not tied to one location, you're generating an income, it pays for itself, plus then pays for your lifestyle after a couple of years, and allows you to be flexible. You can follow the work, chase the work, and not be tired or worried about having to be located in one location. And that even goes for people that are unsure where they want to live. Like, for instance, we live in Sydney now, but eventually the wife's into horse riding. She was born and bred on the Central Coast in New South Wales, and when the market turns, 27, 28, 29, 30 will be the trough of the regional New South Wales property markets mostly. So that's when we're going to look to buy a small acreage horse farm. So we're now living in Sydney, but eventually we want to move. So depending where you are, your stage, in the meantime, just build your wealth, get your capital in the markets, because the markets don't wait for anyone. And the longer you wait, your cash continues to get eroded with inflation. This is what people don't understand. It took me a little while to understand this. Inflation, the trim mean inflation is running at 3.5%. That's the trim mean. That's when you add up everything. Everything has inflation. Everything goes up in value over time as the governments print money and they cause it in the first place. But that's a separate story. But property is on the higher range of inflation. Typically, property goes up 7 to 8% every year on average. Sometimes it's lower, 3 to 5 in the slowdowns. Sometimes it's even higher, 15, 20, 25% in the booms. But on average, 7 to 8% every year. So if you've got 100 grand cash in the bank Every year that goes past, that 100 grand loses its buying power. So if you've got 100 grand in the bank, you hold it for 1 year. At the end of that 1 year, that with inflation, property inflation running at on average 7 to 8% a year, that 100,000 is now worth, after 1 year in the bank, 93,000. So every year it's compounding, losing its value, cash. Same with debt. So debt and cash loses its value over time, and the property value increases in value over time. That's why it's good to get in the market as soon as you can, get your wealth building, build a solid residential foundation, and then if you want to, then once you've built the foundation, leverage it into the family home, sell down half into the family home, or you may even have a penny drop moment and continue to rent in more desirable areas than you ever thought was possible, because you can rent beautiful waterfronts for 1,500, 2 grand, 2.5 grand. Yes, that might seem like a lot of money, but not when it's a $15, $20 million asset, and the interest to the bank would be 5-6 times that. So run your numbers. Run your numbers. So we talked about expats. Next is types of people that will resonate with this strategy. If you understand the 18-year land cycle, so I sort of touched on that already, but I mean the 18-year land cycle, we use it as a framework to invest. Consists of 14 years of expansion, 4 years of downturn. In the midpoint of the 14 years of expansion, we have a mid-cycle slowdown. So the current cycle started in 2012, about 4 years post GFC, where that 2007 top, 3 or 4 years post GFC. The current cycle started in 2012. 14 years up will bring us to 2026. During that 14 years of expansion, we had the mid-cycle slowdown, which was COVID. So if you knew and understood the cycle, I was out of stocks in cash in June, July 2019, getting ready to start buying like crazy come the mid-cycle, which was now known to be as the COVID recession. Stock market takes typically a 50% hit during the mid-cycle slowdown and a 50-60% hit in the land-driven downturn, which is due in 27. So we use it as a framework to invest in markets, as in the first half of the cycle, Sydney, Melbourne outperform. They then get a bit expensive. They then spill over. People get priced out into New South Wales, Victoria regions. They then perform in the midsection. Come mid-cycle, people then had enough of New South Wales and Victoria and then start decentralising interstate into Brisbane, Perth, Adelaide and their respective regions. And they have a solid run like you've seen in the last couple of years. It's not just a coincidence of COVID. If you look at 30, 40 years of sales data, the same thing happened from 2002, 3 all the way up to 2007. Brisbane, Perth, Adelaide, respective regions had a massive run until the market tops out, and then the market will turn in 27, just like 2007, 2008 GFC, and every second one is a big one. So the next one is going to be like the 91 recession we had to have. We sort of sailed through the 2008 GFC. I mean, China was there to save us, but this time around China's property market and economy is not as strong, so this one's going to be a big one, which every boom dwarfs the one before. And now we've got a property tycoon just sworn in, already signing off all his new policies. He's going to be cutting taxes, winding back regulation, dropping interest rates. He's going to set off pro-crypto. The crypto kings are back. Everyone's becoming a guru. Everyone's becoming a spruiker. But you watch, the market will turn in 27. It's going to wipe out all the punters. The market will reset, and then Sydney and Melbourne will then lead again in the recovery. So that's the framework we use to obviously capitalize on the framework, to be in the markets. We're always in the markets 2-3 years ahead of the curve. Most people are ploughing into Brisbane, Perth, Adelaide, Townsville. Everyone wants to go to Townsville. I can tell you now, everyone's going to lose money in Townsville if they keep buying in Townsville, because if you look at history, it had a solid run 2005, 6, 7. It then switched off and went backwards for 15 years to pretty much lower than the price point it was in 2005. So if you're buying now and the next couple of years in Townsville, expect to be in negative equity in the next 5 to 10 years. So if you can't hang on to it and the bank's calling the loan, that shit can send you broke, especially if you're into multiple assets in those markets. So buyers beware. Not everyone's across this stuff, and you got to be cautious. Now is the most pivotal point of time now to be cautious with your investments, because there's only certain markets that you should be or looking to get into, because most asset classes and markets are going to get hammered in the next 3 to 4 years. So if you know that, if you know how history has operated, you can be buying in the markets that have performed from 2005, 6, 7 and onwards, but then also be prepared for the downturn to snatch up the bargains and also protect yourself from interest rates, because interest rates are not going down. I don't believe they're going to stay on hold, and they'll, if not jack them a couple more times. You watch, once all these policies in the US start to flow through the global markets and optimism comes back, it could be another wave of inflation. Inflation's already starting to rise in the States, and they've got a target of 2%. It's already starting to get up to 3%. So the Federal Reserve might not have a choice and might have to start raising again. And I mean, I can tell you, if they start raising again, and I know Michelle Bullock will be already watching inflation in the States, she's not dropping rates. If she drops rates, it'll set off inflation. So they're staying on hold and they're hoping and praying it's enough, but it's like a boiling kettle that's about to pop. So rates are more likely going to keep going up and notching up. And if you don't believe me, look at what happened between 2002 to 2007. They went up out of the dot-com bust, they hovered for a bit, and then in the last 2 years before the GFC, they went up quite aggressively again. So they could even notch them up quickly to try and tame inflation if it gets out of hand again, which ultimately will break something in the economy, and it'll be the start of the next land-driven downturn. So this one's going to be a big one. It's all exciting. We're getting prepared. We're buying in the right markets now to capitalize on the future growth, but then also be cashed up to hedge your bets against rising rates over the next couple of years, and then be ready for the downturn, because once the downturn hits, the RBA will panic. They'll drop rates back to zero, print a shitload of money. It'll be the best time to buy in our lifetime from 27, 28, 29 and onwards in pretty much all asset classes. But you'll need cash, because banks won't be lending shit. So they'll be going back into the hermit crab. They'll be offloading all their bad debts to shore up their balance sheets, like what we saw in the GFC, and it'll be the best time to buy if you got the cash. So now's the time to be cautious, be prepared, and not get carried away with the fear of missing out, because the fear of missing out, those people right now, it happens every cycle. All the stupid money likes to chase yield, chase commercial, chase the hot spots, chase the cash flow, chase all the bullshit, and they'll learn the hard way. So that's the 18-year land cycle. Next people that this strategy would work well with, if you want to build your wealth sustainably and substantially more than you would ever thought possible. Like, I never thought I could build a portfolio as big as I could, and it's around the reasons why is because it comes back to our key fundamentals that I've developed. It's not about what you buy, it's the price you pay relative to the intrinsic value. So half intrinsic value, under bank value, under comparable sales, strong yields, gentrifying suburb, growing population, and market timing based off the cycle. So if you want to capitalize on my experience, reach out. And if you want to really get ahead of what you think is not possible, I can tell you, I can definitely get you further than you ever thought possible. The people I'm helping today are doing even better than what I did. I started when I was 24, bought my first property. I'm helping people now under the age of 25, 22, 23, 24, 25, 17, 18, getting into their third, fourth and fifth property. So they've started a lot earlier than me and are on a solid run. and are using the framework that I've developed. So if you want to get ahead, reach out. And even if you're a big shot, so big shots, I seem to see that the big shots are getting caught up with all the blue chip bandits and going and buying, you know, $1 million plus houses in the regions. Now's not the time to be buying in the regions. The regions have reached their limits in New South Wales and Victoria, and they've slowed since 22. 2 years, it'll probably last 10 years before it then experiences another significant bull run like what has happened between 2021, 2020 to 2023-4. So markets typically go through stagnant periods and then bull runs. They don't just keep going on and on forever. So if you're on 300 grand, 500 to 500 grand, or if you own your own business and you're a big shot and you've got 2 or 3, 4 million bucks to buy property, don't go out and buy $1 million plus house in the regions in Newcastle, or $1 million plus unit in Vaucluse, Tamarama, Bondi, because you won't even get the growth over the next 5 to 10 years in those markets. And I can show you based off of sales history and linking it to the 18-year land cycle. So that's one reason not to. Second reason is that capital that you tie up, you could then put that into blocks of units. Stuff that cash flow in markets that are primed for growth, that have the upside, the development upside. You can buy them in bulk, you can buy a block of units, strata title, sell them off like hotcakes come peak market, or you might just want a strata title to refinance, to draw money back out, to leverage it to more. Blocks of units is where you want to land. The biggest developer in Australia, Harry Triggerboff, started with a modest block of 4 units, then he started building blocks of 4, 6s, 8, 10s, 20s, 50s, 100s. Now these days he builds to rent high-rise 1,000 apartments in each building. So nothing is more stable than 1 and 2 bedroom units, 1 car space, 1 bathroom, solid established blocks that have gone through the test of time. If you're buying them for half the replacement costs, that are in markets with strong yields that are set for their growth run, you'll never go wrong, provided you buy at the right price at the right time, the right market, and they have the development upside. So you could knock it down if it's already got high density. You could, over time, zoning changes, zoning higher density increases, government want to build more property. We're transitioning now in the next 30 to 40, 50 years from being urban sprawl like in the States with, you know, lots of houses, to being like Hong Kong with high rise. So you watch, all the houses, cottages will start getting knocked down, duplex, blocks of 3s, blocks of 4s, and the blocks of units that are already higher density will get rezoned to go, you know, 3, 4, 5, 6 levels high. So if you can buy a block of units that cash flows, it's a development site that has upside in the years to come. So don't go over capitalize and buy a regional house or 1 unit, because you pump a lot of money there where you can get way better return, way better upside in different products. So big shots, I can help you. I've worked for many years for developers and builders. I know how the game works. So don't get conned into shiny brochures, because I can tell you another thing about the blue chip bandits. What they don't tell you is they'll either get you into a regional house and overpay peak market and say throw a granny flat and make it, you know, 5-6% yield. Too much effort. Go buy a block of units or 2 that yielding at 7-8%. Just kick the tenants out, freshen up, and away you go. That has development upside. And don't go buy a unit in Bondi for 1.5 million, or unit in Vaucluse for 1.5-2 million bucks, or Coogee in an older style block, because concrete has a life expectancy or lifespan of 100 years. 100-year design life, they call it in construction, 100 years. But if it's on the ocean, if it's getting the salt, it can be 50-60 years, where the reinforcement inside the concrete starts to corrode and rust. That's called concrete cancer. And what happens? Very hard to fix, what you need to do really to fix it is knock the fucking building down and rebuild it. So I've helped people that have bought the blue chip stuff, supposed blue chip, because they're getting supposed growth, which is not existent, because markets don't just keep going on and on forever. They go through periods of stagnant periods, and then they go through booms and then stagnant. And the blue chip stuff, the regions have hit their limits and they started a stagnant growth period, so that you won't even get growth. But if you buy into a block of apartments that's old, 50, 60, 70 years old, you know, the boutique stuff right on the beach, it would have a level of concrete cancer. I helped a person recently, bought a $2 million unit in Coogee. After owning it for 12 months, got a special levy for $1 million. $1 million was to knock the place down to rebuild it, because it had concrete cancer, they couldn't fix it. So the value of that $2 million unit went to $1 million. And he doesn't have the money, doesn't have the capital to provide that special levy, and they need to knock it down, and it's a disaster, right? If you buy into an old complex right on the beaches, you know, it can be Narrabeen, can be Northern Beaches, can be, you know, near Mossman. The worst of it all is really like Coogee, Tamarama, Bondi, right on the edge of Australia, where it gets all the swell and the salt air smashing those buildings over years. I mean, you park your car there for a day and it gets covered in salt. So you can imagine all the salt over those years going through those buildings creates concrete cancer. And the only way to really fix it, I mean, sure, they can, you know, do injections into the concrete to get a couple of more years life in it, but once it's written in the strata committee reports, there goes your value, because no one wants to buy into that stuff. It's a disaster, and the only real way to fix it is to knock it down and rebuild the whole thing. So buyers, beware. The blue chip bandits will get you conned like no time ever before. So I mean, just wrap it up in a conclusion. Obviously the strategy is not for everyone. Not everyone's built to build a, you know, property portfolio. I mean, even statistically, less than 1% have 5 or 6 more rental investment properties. So that's only 25 or 26,000 people in Australia have 6 or more, and I think it's less than 0.5% have 10 or more. So obviously it's not for everyone, even statistically, but if you want help getting into the top 1%, I can help you. I've done it for myself. I've got all the connections, I've got the experience in construction and development. I look at it from a strictly numbers, strictly development lens of how to build a sustainable portfolio that will tick away in the background and will only complement your lifestyle and not be a drag and a burden on your lifestyle, like going and buying blue chip stuff. So even if you're a big shot, think twice before going and buying a Bondi Beach Tamarama unit, especially if it's an older unit that's going to get concrete cancer, or pumping a heap of cash into Newcastle region, buying $1 million plus house and building a unit, a construction donga granny flat out the back. You could use your money more wisely into larger assets that cash flow in markets that are set for growth. So big shot or not, reach out today. I'll put my details in the comments below. Shoot me a comment, give feedback, like, dislike, share, subscribe, do whatever you got to do. Shoot me an email if you've got property, if you're unsure, I can help you. We can get on a call, we can discuss your position and how I can help for the years ahead to navigate the turbulent times ahead. It's not all going to be sunshine and rainbows. So if you've got experience and you understand the cycle, you'll do well and you'll prosper. But if you're just winging it and going by the seat of your pants and dawdling along and trying to do it yourself, then this is definitely not the time to be trying to do it yourself, because you may well get caught out and burnt when the market turns. I thought I'd touch on, I'm only a small operator. I mean, I'm not, as you can see, I'm on my boat today. I've got a few phone calls, a few strategy sessions. I like to work with You know, I just came out of corporate gig, all that corporate life. I'm looking to build a community around me that's small knit. I only really need 100 clients ongoing. So for that reason, I'm very selective now on who I take on board. And if this resonates with you, if you think, you know, you want to work with me and we would work well together, I only need 100 or so, 200 clients ongoing, repeat clients that have the bigger picture in mind, who want to build the portfolio. I'm not a tick and flick buyer's agent. Yes, I operate as a buyer's agent, but as you can probably tell through this video, you'll get a lot more than just the buyer's agent transaction. You'll get the ongoing support through the whole lifetime of building a sustainable ongoing portfolio. I see clients that come on board will be a client for life. So for that reason, I'm very selective, very limited with the people I want to take on board. I can't help everyone. So there's only probably a couple of hundred spots really available. Once I hit my limit, I'll decide whether or not I'll want to scale the business to the next level, but I just come out of all that. So at this point in time, limited spots available. I'm only really working with 3 to 4 people a month. So no tire kickers. If you're ready to rock and roll, hit us up. Happy to chat. If we work well together, happy to help you build your solid foundation portfolio and navigate the markets ahead. Hope you enjoyed it. Until next time, happy investing.